If you're into dividend investing, you've probably heard of SCHD. It's been a go-to for many investors because of its stability and reliable income. For years, it's been a solid pick for anyone looking to balance income and growth in their portfolio. But as we progress, we're seeing more and more ETFs seemingly sprout out of nowhere and undo the SCHD. Most of them are unable to sustain the growth and disappear as quickly as they popped up. However, there are some that have outdone the SCHD and continue to do it year by year. One such ETF is the DGRW, which has been making waves as a strong alternative, promising consistent dividends and significant growth potential. But is it worth something? Is it better than the SCHD? Well, let's see. SCHD, the Schwab U.S. Dividend Equity ETF, has long been a staple for dividend-focused investors. Its reliable performance, low expense ratio, and consistent dividend payments have made it a favorite choice for those seeking income and growth in their investment portfolios. Over the years, SCHD has built a reputation for stability and has been a go-to option for many looking to build a robust dividend strategy. However, there is a new ETF that is generating a lot of buzz. DGRW, the WisdomTree U.S. Quality Dividend Growth Fund. This ETF is quickly gaining attention as a potential better alternative to SCHD, particularly for investors interested in combining dividend income with significant growth potential. DGRW's unique approach of targeting high-quality, growth-oriented dividend-paying companies sets it apart and makes it a compelling option to consider. But how does it truly compare to the well-established SCHD? To make an informed decision, it's crucial to delve into the specifics of each ETF. We will start by analyzing what SCHD offers and how it has performed historically. Then we'll take a look at DGRW and explore its key features and performance metrics. Finally, we'll conduct a performance comparison of the two ETFs to see how DGRW stacks up against SCHD. This analysis will provide a clear picture of which ETF might be better for investors seeking a blend of income and growth. Let's begin with SCHD. Well, this one is a widely respected and popular investment vehicle designed to provide investors with exposure to high-quality dividend-paying U.S. companies. Launched by Charles Schwab, this ETF aims to track the performance of the Dow Jones U.S. Dividend 100 Index, which includes 100 of the leading U.S. dividend-paying companies. The primary goal of SCHD is to deliver a balance of income and growth by focusing on companies that pay dividends and have a history of increasing them over time. One of the most appealing aspects of SCHD is its remarkably low expense ratio of just 0.06%. This makes it an extremely cost-effective option for investors looking to minimize fees and maximize their returns. Low costs are a significant advantage in the world of ETFs, as high fees can erode investment gains over time. So, with SCHD, investors can be confident that more of their money is working for them rather than being lost to management fees. SCHD holds a diverse basket of stocks, ensuring that investors are not overly exposed to any single company or sector. The fund includes companies from various sectors, such as technology, consumer goods, healthcare, and financials, among others. This broad exposure helps to balance the performance of the fund, as different sectors can perform well under different economic conditions. One of the reasons SCHD is so well regarded is its long history of paying and raising dividends. Companies included in the Dow Jones U.S. Dividend 100 Index have not only paid dividends consistently but have also demonstrated a commitment to increasing those dividends over time. This is an attractive feature for income-focused investors, as it provides a reliable stream of income that has the potential to grow, helping to keep pace with inflation. The emphasis on dividend growth also indicates that the companies in the index are generally financially healthy and well managed. Broadcom, a leader in the semiconductor industry, is one of SCHD's top holdings. Known for its strong performance and substantial dividend payouts, Broadcom is a prime example of the type of high-quality company that SCHD targets. Its consistent dividend growth and robust financials make it a cornerstone of the fund's portfolio. Verizon, another top holding, is a major player in the telecommunications sector. Verizon has a long-standing reputation for providing reliable dividends, supported by its strong cash flow and dominant market position. By including such stalwarts in its portfolio, SCHD ensures that it captures stable and growing income streams for its investors. Other top holdings in SCHD include Texas Instruments, PepsiCo, and Home Depot. The low expense ratio, combined with the high quality and diversification of its holdings, makes SCHD an attractive option for many investors. Whether you're a retiree looking for a steady income stream or a young professional building a long-term portfolio, SCHD offers a compelling combination of growth and income potential. Its focus on companies with a history of paying and raising dividends ensures you can benefit from capital appreciation and growing income over time. And now, what about DGRW? Now, this one is an exchange-traded fund designed to provide investors with access to dividend-paying large companies in the U.S. that also exhibit strong growth characteristics. Managed by WisdomTree, this ETF seeks to track the investment results of high-quality companies that pay dividends and have the potential for significant growth. This dual focus on income and growth makes DGRW an attractive option for investors looking to balance these two important aspects of their portfolios. One of the standout features of DGRW is its expense ratio of 0.28%. While this is higher than some other dividend-focused ETFs, the cost is justified by the unique benefits and high-quality holdings the fund offers. Investors in DGRW are willing to pay slightly higher fees to gain exposure to a carefully curated portfolio of growth-oriented dividend payers. The higher expense ratio is a trade-off for the potential of higher returns and more dramatic growth opportunities within the fund. DGRW is particularly notable for its monthly dividend payments. Unlike many ETFs that distribute dividends quarterly, DGRW provides investors with a steady stream of income every month. This feature is highly appealing to income-focused investors who prefer regular cash flow, as it allows for better budgeting and financial planning. Monthly dividends can be especially beneficial for retirees or others who rely on their investments for regular income. One defining characteristic of DGRW is its higher concentration in technology stocks. This sector allocation reflects the fund's emphasis on growth potential, as technology companies often exhibit faster growth rates compared to other sectors. This focus on technology means that DGRW might experience more volatility, but it also offers the potential for substantial capital appreciation. The inclusion of leading tech giants ensures that the fund is positioned to benefit from ongoing technological advancements and the significant economic impact of this sector. Despite its concentration in technology, DGRW maintains a diverse portfolio with nearly 300 holdings. This diversity helps to mitigate risk by spreading investments across various sectors and companies. The fund includes significant allocations in consumer goods, healthcare, financials, industrials, and other sectors. This broad diversification provides stability and reduces the impact of poor performance in any single sector on the overall fund. Microsoft, which is one of DGRW's top holdings, exemplifies the type of high-quality company the fund targets. As a leading global technology company, Microsoft is renowned for its consistent revenue growth, strong cash flow, and substantial dividend payments. Its dominant position in cloud computing and software ensures ongoing growth opportunities, making it a cornerstone of the DGRW portfolio. They also invest in Johnson & Johnson, a leader in the healthcare sector. Known for its broad range of healthcare products and pharmaceuticals, Johnson & Johnson has a long history of paying and raising dividends, contributing to the reliability of the fund's income stream. And how can they be left out on Coca-Cola? With its global brand recognition and extensive distribution network, Coca-Cola provides additional stability. As a leading beverage company, Coca-Cola generates steady cash flow and maintains a strong dividend history, contributing to the fund's income and growth potential. Other notable holdings in DGRW includes companies like Cisco Systems, Merck, PepsiCo, and Pfizer. This ensures that the fund is well positioned for both current income and future growth. What about we now compare their performance? You see, when comparing the performance of SCHD and DGRW, you'll find that DGRW has distinct advantages that make it particularly appealing. Looking at overall growth, DGRW stands out with a remarkable 240% return over 10 years, translating to an annualized return of 12.3%. This performance surpasses SCHD, which achieved a 203% return over the same period, or an annualized return of 11.07%. While both ETFs have delivered strong results, DGRW's superior growth rate highlights its potential for greater capital appreciation. This edge in growth can be particularly attractive for investors who are not only looking for steady dividend income, but also for substantial increases in their investment value over time. When it comes to dividend yield, SCHD starts with a higher yield, making it an excellent choice for those who prioritize immediate income. However, DGRW, despite its lower starting yield, offers consistent dividend growth, which can be equally, if not more, appealing over the long term. DGRW's approach focuses on companies with strong growth characteristics that pay dividends, ensuring that the yield remains stable and grows steadily. This consistent growth in dividends can help investors combat inflation and increase their purchasing power over time, making DGRW a compelling option for those with a longer investment horizon. Moreover, DGRW's higher concentration in technology stocks position it well for future growth. Technology is a sector known for its rapid innovation and high growth potential. DGRW taps into these substantial growth opportunities within this sector by including leading tech companies like Microsoft and Apple. This strategic allocation means that DGRW is not just riding the current wave of tech growth, but is also well positioned to benefit from ongoing advancements and the increasing integration of technology in various industries. This focus on technology can drive significant long-term gains, making DGRW an attractive choice for growth-oriented investors. Another appealing aspect of DGRW is its monthly dividend payments. While SCHD pays dividends quarterly, DGRW's monthly distribution provide a more frequent income stream, which can be beneficial for those who rely on their investments for regular cash flow. Monthly dividends can help investors manage their finances more effectively, providing a steady stream that aligns with monthly expenses. This feature adds to the attractiveness of DGRW, especially for retirees and others who need consistent income. While both SCHD and DGRW are excellent ETFs with strong performance records, DGRW offers more advantages that make it particularly appealing. Its superior overall growth, consistent dividend growth, focused on high quality and high growth companies, and monthly dividend payments position it as a standout choice for investors seeking a combination of income and capital appreciation. So now, what are your thoughts on SCHD versus DGRW? Which ETF do you think is the better choice for your investment? Comment below and let us know. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more insightful comparisons and investment tips.